So the tax season is just around the corner. For those of you who own investment properties, I am one of them. I'm sure you're probably thinking, what are the write-offs you could gather to maximize your tax efficiency? So today I have a chance to talk to my CPA to discuss some of the write-offs that you do not want to ignore when it comes to filing your income tax as an investment property and rental property owners. Let's get straight into his tips. So Neil, let's talk about investment property write-offs. What are the top write-offs if someone owns investment property you should consider?
Investment property is a great vehicle for write-offs. These include investment properties, primarily rentals that we see. Certain taxpayers have one property for rentals, some have as many as 10. And the reason why rentals do so well is because you take depreciation write-offs for rentals, something that you wouldn't be able to do if you had a personal home. You can not depreciate your personal and primary residence. So when you have a rental, you can deduct anything associated with the rental, whether property taxes, mortgage interest, insurance. Home insurance is deductible. You can deduct any expenses related to the construction of the rental. So if you have a remodel, you capitalize that remodel and depreciate it. In 2023, there is an advantage to remodels that you can get an 80% write-off, depending on certain capital expenditures, that you can get an immediate 80% write-off, which will reduce your liability with the rental income. So it's a great tax vehicle for deductions and offsetting your other income that you may have from other sources.
So Neil, how about management related expenses? Can those be write-offs?
That is a great question, Heather. And yes, a lot of homeowners or rental investment property is managed by, say, fees from Airbnb, or they may have a local person do the management of the rental, such as a management company. So those fees are generally a percentage of the monthly rental, and those fees can be fully deducted for that rental property. Another piece of deduction is if you have a rental that you have to travel to in order to visit the rental to make sure that the rental condition is in good standing. So you may have to make a trip. So those expenses are deductible as well. If you travel to your investment property and you conduct business there in the way of review and evaluation of it, that those travel expenses are related to your investment property and they are deductible because they're related to the property. Another expense that you may consider is the expenses around managing the property, whether it's cell phone or travel that are associated with the rental property. All those expenses related to the rental should be itemized and should be kept and deducted with the associated property.
Sounds good. And I know that for many property owners, in order to find the right tenants, they have to advertise. So I assume that any fees that incur in finding those tenants, such as fee costs that involve in posting the rental ad, can also be deducted.
That's right. If you're advertising and you're paying for the advertisement, it's important for you to include that and any associated costs with putting that property into production. That's the key. So you want to capture all those expenses that you're incurring because those expenses are valid business expenses related to the rental.
Sounds good. So can we transition to if a property owner, investment property owner, when it comes to selling their property, I know that 1031 exchange is a big topic. Can you expand upon that? What are the taxable events and what are the pitfalls you've seen, things to pay
Mhm.
attention to when it comes to 1031 exchange?
Sure. 1031 exchange is named after the code section that it is called by, which is 1031. And that is in the Internal Revenue Code that's been around for decades. I would say that 1031 is one of the few remaining tax deferral vehicles that investors are using with a lot of that are favorable from a tax standpoint. 1031 exchanges have changed over the years. Now they're limited to real estate property. It used to be that 1031 exchange, you could exchange like kind property. so that you could trade in a car, that you could exchange a car for another car. That's no longer allowed. It's only limited to real estate property. And real estate property is going to be property that is used for rental purposes or investment purposes. So if you have a rental, you can use the 1031 exchange to exchange a property that you have been renting into possibly a larger property, maybe one that is multifamily. And the idea behind that with real estate is that you're growing your investment and you're continuing to defer the tax that goes that you would have to pay. That's an important tax vehicle for a lot of investors. The key thing is with tax is that you want to accelerate deductions and you want to defer income as much as possible until within the law until you have to realize the gain and recognize the gain and pay the tax on it. The name of the game for tax purposes is accelerate deduction and defer income within the parameters of the law.
I love that recapture. Could you talk a little bit about foreign investors? If a foreign national own the property, is there anything special about these individuals when it comes to selling their investment property?
Yes, and there is, Heather, because foreign investors, as they're growing in the Bay Area, we know that this area has attracted both domestic and foreign investors. And for foreign investors, because they have to withhold in real estate transaction the amount subject to tax, they are required to withhold a certain amount of taxes when they sell or exchange the property. And the reason why this is important is because sometimes the withholding is significant. It could be as high as 30% of the sales price. And you want to plan for that. And there are mitigating circumstances that you can request for a waiver if allowed, or you can have a declaration where you may mitigate the withholding amount that you have to pay. I highly recommend you talk to your real estate agent and also talk to the escrow company when you enter a contract for sale or for exchange. It's really important so that you know what to expect when that amount comes into play. Because with 1031 exchanges, sometimes the withholding could affect you in the gain realization and the gain recognition in the form of boot. And this is a technical term that is part of the 1031. Whenever you receive cash out of a 1031 exchange, there is a potential for you recognizing gain to the extent of the cash you received.
I hope those tips are useful to you when it comes to organizing your expenses and getting ready for the tax season. If you are interested in learning more about 1031 exchanges, I did this video, the property that I recently did a 1031 exchange into. So make sure you check this out.